In this past weekend's video, I shared with you a top trading setup on the Euro Yen, and I also told you that this wasn't a random pair. This was a market that we've been stalking, studying, and really taking advantage of over a long period of time. Well, today I want to rewind the tape, and I'm going to take you back through some of the recent analysis that we did over the Euro Yen, and more importantly, I'm going to drop some serious lesson bombs along the way. We're going to talk about making directional predictions, we're going to talk about adding filters, and by filters I just don't mean like indicators or stuff like that. I'm talking about learning how to actually read price and how that can keep you out of trouble. From a technical perspective, we're going to talk about double tops, flag patterns, and we're going to answer one of the most important questions that traders need to address, which is what matters more, trading signal or directional prediction. Now, here's the key. When it comes to trading, we shouldn't be doing any guesswork. We should have set in stone answers. And an easy way to have a set in stone answer to that question is by having, and more importantly, following a trading process. And when you have a process that you follow, not only does it create a directional bias that allows you to filter out those less than ideal trading opportunities, but it can actually put you in position to make more out of your grade A trading opportunities. Oh yeah, and before we hop in, we're also going to talk about morphing patterns. What I mean by morphing patterns is how a setup could start as one thing and give you a certain signal, and then over time it transforms and transitions into a different thing that gives you another signal. Now, I know that's a lot, and the final topic is pretty much on what many of you are feeling right now: information overload. And more importantly, how to stop yourself from trying to process everything on the chart at once and focus only on what matters for you at that very specific time. So if you want to have clear analysis, make better decisions, and really a process that keeps you grounded when it comes to trading the markets, give this a watch. Oh, you already are. All right, let's hop in. Euro Yen, again, bigger picture. This was our breakout here. So this was one that we had a directional bias on. We had a conversation yesterday about the trend line versus slanted trend lines versus horizontal trend lines. You can see that we did indeed get a break and close above, beyond, not just the slanted trend line, but the horizontal trend line as well, that yellow one up there. So we can now look for bullish continuation trades, and by we, I mean me, right? So you can see price action has already come back to retest structure, right? Funny how that happens. Yellow line was structure. We broke and closed above structure, came back. Where did we kiss? Smooched right off the yellow line. And then we started to move back up, giving us a double top. Now, curious, what do you guys think about this double top? Something you would be interested in trading? Something you would stay very far away from? Somewhere in the middle, you're not sure. What do you guys think about this? Dave says keep out. Why? Ali says not interested. So why are you keeping out? Why are you not interested? Jackson says sell. David says looks like it could carry on. Okay, but I need something more than that. So looks like doesn't really give me anything. That sounds, when I hear looks like it's, I see that as more of like an emotional answer, like an intuition, a gut-based answer. Is there anything factual that you can say? You're on the right track, Dave. I like it, but I just want a different word for it. I don't want looks like. What causes you to think it looks like it could carry on? RSI declining? Nope. That would be beneficial to the double top, though. That would be divergence, right? This would be our divergence where we have our equal highs here, and we have our, not only our RSI over bought on the first test. One day I'm going to get these arrows on the correct one. Not only do we have RSI over bought on the first test, but we have divergence on the second test. So this would be a positive for the double top. Kevin said it formed a bull flag. No, I wouldn't call this a bull flag pattern. Nope. There are higher lows at the moment. Nope, that's going to be natural in a double top, right? We have to have a higher low in a double top. I love the brainstorming though. This is, the gears are spinning. This is my favorite game. This is how you learn. I do this in coaching athletics a lot, track and field, where it's like, instead of just teaching them something, let them figure it out, where I give them something to do. I'm like, hey, I need you to make it from here to here. Well, how do I get there, coach? I don't know. figure it out, right? And your body goes through all these things of figuring it out, and it's a learning mechanism. So I love this brainstorming game of it could be frustrating because I'm not giving you the answer yet, but you're thinking, you're diving deep into different scenarios. So this is the sandbox game, just with people. The sandbox game, where I say you play in the trading sandbox. You can do this on your own. It's easier when you have other people to do it with. But so for me, it all comes back to our IPDE, right? So if we go back to the daily chart, right, and this is the importance of perspective, and even writing down your perspectives, guys, right? Writing it down. Like I have it's on the website somewhere, but I have a pre-market checklist where I don't know, I can't find it here. It's hidden somewhere in one of my external hard drives. That is, it's on my laptop anyway. But I have a pre-market checklist, and it's pretty much you're writing down your daily ideas. So when we start with our IPDE process, what was the first thing I said when we looked at this chart? What did I say price did? Price broke out of our bullish pennant pattern, right? It put in a higher high, higher close, not just of the descending trend line, but the horizontal line. Okay. So based off of our IPDE, identify, predict, decide, execute, if I get a higher high, higher close, my prediction is in what direction? Higher high, higher close, prediction, bullish, right? And then the next part of prediction is obviously where do we think it's going to go bullish to? And I don't know if I have my notes still up here. This was one where we thought we were going to go bullish all the way to, what was it? 186 is somewhere up here higher. I forgot the exact number, but somewhere all the way up here. All right, so keep that in mind, right? Write it down somewhere. And then as we go down to the lower time frame, okay, so now we see this double top. And we're automatically kind of intrigued and kind of pushed in a certain direction because you see and hear a double top and you automatically think what direction, bullish or bearish? The thing that is the double top, is that a bullish or a bearish thing? It is a bearish thing, right? So automatically we're saying to ourselves, okay, well, I see the bearish thing, all right, bearish, 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 bearish. But how soon have we forgotten what was our original prediction? Was our original prediction bearish or was it bullish? So what is trumping what? Is it the overall prediction that matters more, or is it the individual thing that matters more? Now, ideally, you want to have everything lining up together. So if a double top formed at an area where you predicted the market to go bearish, boom, now everything's in alignment. This is not necessarily in alignment, right? Because on one hand, you have your overall prediction, which is screaming bullish, whatever a bull would sound like when it screams. And then you have your thing that you noticed as you go down to a lower time frame, which is bearish. Well, you can see the disconnect here. Now, personally, from my perspective, and I have this rule from with double tops in general. So if price breaks and closes above structure, right? This yellow line was our level of structure, right? If I'm a trader looking for a pullback trade, where is the first place I'm looking for that pullback to come to? Meaning I'm looking for a price to give us some relief, to retrace. Where am I looking for that pullback to come to? Back into our previous level of structure resistance, which should now act as support, which is this yellow line, right? Previous level of structure resistance, broken and closed above, now acts as support. Price did that already. Right? So price is working in that overall trend continuation prediction that I have made. So there's no reason for me personally to be interested in this double top because one, I see this as a retest of structure of a trend continuation setup because that's the overall bias. And two, again, it doesn't fit with the overall bias. Now, Is that a rule or a process you have to follow? No, you could be someone that trades every single double top in the world. Again, I would advise that you have some type of filters, because if you just trade every single one, you're going to lose money pretty quickly. But you can have filters that say, hey, my filters are overboughtness and diversions, and that's it. But for me, this is what separates this from being a double top that is tradable versus a double top that you would just look at. So I would have no interest in this double top, mainly because it doesn't line up with the overall bias. And again, what we're looking at with this overall bias is, again, it's our confirmation bias. We do our overall analysis to create a directional bias, and then we want to follow up on that directional bias. If we're not following up on that directional bias, then what is the point of doing that directional bias in the first place? So hopefully that explains it. Any questions about that? Any questions about that? There's too thin profit margin. Well, yeah, and that's another question too. Where would you take profits at if you were to trade? And there's multiple answers for that, but even before we get to the profits, it's like, again, in the general theory, if we don't think price is likely to go bullish or bearish, why are we involving ourselves in a bearish trade? If that's your way of thinking. Would this still apply at the 60-minute chart? Yeah. Yep. As long as your directional so it would still apply on the 60, because no matter if we're on the 60-minute chart, this level of structure is still existent. So price has broken and closed above it, pulled back to it. There's still no level of structure up here to support our double top. So even on the 60, I still don't see any reason to look for shorts up here. If anything, the 60 is an even clearer reason not to. Now, can you, I would say, can you shoot from here back to here? You can. Again, I wouldn't even be doing that. As soon as I see this, I think trend continuation. I think bullish trend continuation, right? This was previous structure. This was the violation of structure. This is a pullback. For me, this is a pullback trade. And in a pullback trade, what am I expecting? I'm expecting an extension. So if I'm expecting an extension, I don't want to be short right here, because that goes against the thing that I'm expecting. So again, it all comes down to, you want to align your trading actions with your trading observations. Now, again, if you've done analysis and you're saying, hey, I'm predicting shorts for this reason at this level for whatever reasons, and that's your directional bias, then it's okay to take it, because it's in alignment with your directional bias. So the point I'm trying to make is, like, we don't want to spend a lot of time doing all this analysis and thinking bullish, 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 and then we do something that is completely against what we think. That doesn't make any sense. So we're not here to argue whether your directional bias should say bullish or bearish, because different traders have different opinions. How I analyze the market, it says a bullish bias, but not everyone analyzes the market the same way. We all use different measures. The general point is, if you're using a process like this, the what should align with the where. They shouldn't be opposites. You shouldn't be looking at a chart and saying, this is a bearish chart, and then taking a bullish trade, because that just doesn't, why? That's like betting on a team that you don't think is going to win. Jackson says, will you take that this is so far the highest point at the moment into consideration before a long position? No. So this isn't the highest point at all. If we look back, and again, this is one where we got to go back to 1990, right? This is not, these aren't all-time highs. So you can see that we've traded much higher. Yeah. So if you're trading at all-time highs, it's a little risky. because one, you don't have a target on where price can go to. And then two, people get weird at all-time highs, right? If you think about like the natural kind of supply and demand, right? Just from a psychological perspective, like supply and demand for dummies, if you're going into the store and eggs usually cost you $3, and the highest price eggs have ever been in life were $3.50, and all of a sudden eggs are selling for $4 or $5, right? Are you more likely to be comfortable buying those eggs for $5, or are you kind of telling yourself, prices will come back down, right? You're probably telling yourself, I'll wait till prices get a little bit cheaper. So whenever you're trading at all-time highs, it's weird. It depends on the asset. Like gold is a different story, right? That's more of an investment type of thing. But when you're trading here, it's and like indexes are different stories because they're supposed to go up. So if you trade in something that is naturally supposed to get higher, like the S&P, for example, it's not that big of a deal. But trading in the currency market, especially in a market that tends to consolidate, all-time highs are a little bit weird because everyone's a little bit scared that this is the top, this is the top, this is the top. So like every little move, people are waiting to kind of bail on their positions and take money. But yeah, in this case, we're nowhere near all-time highs. We're at 180s. All-time highs are up at what, 286. So no, that wouldn't play a role at all. We have a long ways to go. A long ways to go, but nice. Understand, thank you, using more than one clue before coming to a conclusion. Yeah, but even before that, just following a process. Directional bias. Even before you put your clues together, just directional bias, IPDE. Just IPDE. All right. Any questions about this subject? There's also something else on the chart. Can you guys see it? That is forming. That could be an excuse to get long. Yes, a Gartley or a bat pattern. I haven't measured any of this stuff out. I'm hoping it's a bat pattern. But let's take our swing low to swing high right here, our X to A. I'm going to take my Fibonacci retracement and I'm going to measure it. I'm going to pray that it's a 50%. I think it hits right on the 618. My fib eyes, right? Years ago, I had my eye replaced with a mechanical eye that only shows me Fibonacci levels. Oh, man, that sucks. All right, we hit a 618. Way to jinx it, Ollie. We've got a Gartley, right? I'll show you why I'm disappointed in a little bit. But that gives us a look. It's actually not too far off. It's only about 5 pips off still, though. It's going to make a difference. But we're looking at a move that looks like this. Let me use this deal so you can see the X's and the A's. Swing low to swing high, X to A. Retracement to our 618, A to B. Retracement not to our 618, not past our A leg, B to C. And then a move down here right to our 127 extension is our Gartley pattern, with the zone being from our 127 all the way to our X leg. Now, this is a bullish pattern, obviously, avo, right? But once again, going back to our overall analysis, what was our directional bias for this market? Type it in while I type this into the chat. And I'm gonna get this into our pro trade log as well as soon as I load it up. So many good messages. Yeah, so we have that overall bullish bias. Yeah, so this is an opportunity where you have a few options. One, you can trade this as a Gartley in its own right. So one would be it's just a Gartley, right? Just a Gart. Two would be you trade this as just an entry to the bigger TCT trade, right? Trend continuation trade. So this is your entry reason. Instead of looking for higher high, higher close, or double bottom or whatnot, like this is your entry reason. Three is you do both, right? Half Gart, half TCT, or however you want to break it up. Meaning that you take it as a GART, but maybe you look for, instead of the traditional target 2, maybe you look to hold on your position for more extended targets. So look at that. That's actually a pretty cool opportunity. I forgot who told me to go down to the hourly, but I'm glad you made me do it, because that works right into kind of our overall conversation. So yeah, look at Euro Yen being friends again. Euro Yen was my favorite pair about 2 years ago. I absolutely gutted it for profit, and then I don't think I had to trade on it for like 2 years straight. I took all I had from it, and then it just I didn't have anything. It just did nothing. But now it's back. Now I want to take a quick break just to give your mind some time to process what we just learned and kind of refresh before we learn something else. But we're going to dive into the topic of information overload. And before we get started, I want you to understand, learning information is good. It is good to be knowledgeable. It is good to learn. It is good to process information. But if you don't know how and when to properly use that information, you can get yourself in a lot of trouble, and it can even work against you. So let me give you an example, and I'll use my wife's cooking. Now, don't worry, she's not here, so I can speak open and confidently and freely about this. That being said, she is subscribed to the channel, so if this is my last video, I appreciate you for watching, and I bid you farewell. Anyway, when it comes to cooking, right, my wife loves flavors. She's also incredibly indecisive. So when she's in the kitchen, right, she tends to grab every single thing that we have in the cabinet and use it on the meal. Now, don't get me wrong. The meal always turns out tremendous, and I would never ask for a better meal. I am so blessed to have a wife that can cook tremendous meals, as I just mentioned. But for someone who isn't possibly married to this wonderful and 100% perfect, beautiful woman inside and out, they might say, hey, that's a little bit too much. Trading works exactly the same way. You see, when we learn about trends and structure and indicators and simple patterns and advanced patterns and candlestick clues, you name it, it's all good. We want to build our knowledge base. We want to have that encyclopedia of information in our brain because we never know when it will come in handy. But when it comes to trading, we have to understand that that's very different from learning and very different from simply doing analysis. In actual trading, I'm talking when you're planning on analyzing a chart and placing an order on, we need to understand which tools are relevant for the job at hand and which tools need to stay in the garage. If you don't, you're going to become incredibly overwhelmed, and you're going to fall into that infamous analysis paralysis where you see so much on the chart that you don't see anything and you freeze up. Just like that. So in this next part of the video, we're going to talk exactly about that. But real quick, shameless plug, if you have this same information overload about what needs to be in a trading computer, you're seeing all this stuff online, you don't know what's important, what's not important, I have a simple solution for you. QR code is on the screen, link is in the description box below. Free trading computer guide. Download it, browse it, learn what you need, learn what you don't. And that way you have the information ready for when you're ready to either buy your own or build your own yourself. All right, now let's hop in to the zone. Now, this thing, this is a good example of a morphing pattern, I guess you can say. If you guys remember Euro Yen, we were originally looking at a pennant pattern that broke out to the upside. We have now shuffled sideways. Who can tell me what this sideways pattern is called? It is a very powerful pattern in the market. It is a flag, but specifically what type of flag? We don't see them too often. Yep, high and tight flag, high and tight flag. Very, very powerful breakout patterns. It's when the market, instead of consolidating and taking kind of a breather to the downside, it can't even go to the downside. It consolidates and goes flat. And typically this is followed by a breakout in the original direction of the trend. Now, as always, what do we need to ask ourselves about this flag pattern? Should we just look at it here from this perspective on the 4-hour, or do we need to do something else just to get a general view of what's happening? I don't want to give away the answer. Yeah, so let's make sure that this is a flag pattern where we would expect the high and tight flag, where we expect a breakout to the upside. let's make sure we actually have room to break out to the upside. I'm going to go up to the weekly because, again, we've done this before, so we know that the daily isn't going to give us enough information. So let's go to the weekly. And if we remember, right, and you should have this in your pre-market checklist, we're in the middle of this bigger consolidative area, but we certainly have room to get to the highs here, right? The 186 level is what we're looking at. So yeah, plenty of room to go higher. So we got a nice high and tight flag. Here we go. We have a nice high and tight flag here. We do have room to go higher up there. This could be an excellent opportunity to look for a breakout. Devin says divergence on the RSI question mark. I want you to tell me. You tell me. Is there divergence on the RSI or not? No question mark. And let me get this in real quick. Euro yen for our bullish high and tight flag. Yes, there is. Yeah, no question mark needed, right? Again, one thing I like, guys, give me confident answers, right? I want you to train, and sometimes there are questions, obviously, but I want you to train yourself to give confident answers. I don't want to see divergence, question mark. I want you to tell me, is there divergence, right? Practice being confident in whatever your answers are. And if it is right, I will confirm that you're right. If it is wrong, I'll just tell you that you're wrong, and we'll correct it. But divergence, guys, what do you guys say? RSI divergence? Yes. Now, here's a question. For the high and tight flag pattern, does this divergence have relevance? Not really, right? As a counter trend trader, yes, if we're looking for a short. But as far as the bullish breakout, doesn't really affect us there at all. But good identification. Yep, there is divergence there. Good job. Just want to make sure you're confident in saying it. That's all trading is. It's building a lot of confidence, unfortunately. And it's hard to build confidence because half the time we don't think we see what we see, or we see what we don't see. It's weird, but you can practice it. So he says, flag versus divergence, which one is stronger here? Well, the two can't be compared. They're two different things. The flag is a pattern. Divergence is a setup on an indicator. So it's like me asking, who is better, Real Madrid or the Dallas Cowboys? Right? They played two different sports. So it's not something that we can compare. Now, the question that we want to ask here is, and this is where we get confused. The question that we need to ask is, which one matters? So let me ask you this. As a trader looking for this type of regular divergence, right? This would be used in what type of trading scenario? Bullish or bearish? So what would they be looking for? I'll write D for divergence. Bullish or bearish for the trader looking at this divergence? This would be something that is helpful in a bearish scenario, right? You're looking to short. For the trader that is looking to trade the flag pattern, is the flag pattern a bullish or bearish setup? The flag pattern is a bullish setup. So one affects one, the other affects the other. How do we know which one matters to us? Well, this comes down to the simple question of, what are you looking for in this scenario? As a trader, are you looking to get bullish or bearish in this scenario? And again, there's no one common answer. It depends on the trader and the trading style. But that's the question that we want to ask ourselves, right? If I'm a trader that is saying, hey, I'm looking for counter trend shorts, right? I'm looking at this extension up. I'm looking at the market hitting a point of exhaustion. I am looking to sell at this area. Well, they're looking bearish. Therefore, this divergence may play a role in their decision making, right? Double top, right? At the time, double top, divergence, building my CTS score to get short. For a trader who is looking to get bullish and saying, okay, I'm looking to trade a flag pattern breakout. Well, this divergence isn't relevant in their flag pattern at all, in their high and tight flag. So it doesn't mean anything for them. Does that make sense, guys? And again, this all goes back to our process, right? The IPDE process, the thing I pound into your head every day. What is the first step of our IPDE process? Scream it to me. I want to hear it. It is identify. What is the next step after identification? It is predict. So once we identify and predict, we create a what? What do we create? A directional bias. So at that point in the process, right, IPDE, before we ever get into decide and execute, which is the specifics of our trading strategy and pulling the trigger, we've created a directional bias. And what that means is that I know when I'm looking at the euro yen, with whatever I identify, I know I'm either looking to only get long or I'm looking to only get short. Therefore, by the time I get to this part in the process, if I'm only looking to get short, does the flag pattern mean anything to me? No. It has nothing to do with my short position. If I'm a trader only looking to get long, does the bearish divergence mean anything? No, because I'm not looking for shorts. And that's how we clear up the confusion. That's how we avoid the analysis paralysis where we see so many things. Oh my gosh, it's a flag, it's a divergence, it's a double top, it's a this and a that we freeze up and we do nothing. This is why we want to have a process. We need to have a process that gives us direction. It's the difference between, I don't know if you guys have ever heard of a store called IKEA. It's a Swedish furniture store. It's a brilliant business design because there's only one way in and one way out. So in order to get out of the store, you have to go through the entire store. Yeah, you can't just turn around and exit. It's one-way traffic. And you got to go through everything. You got to see everything they offer before you can make it out the store. And they have really great meatballs as well. But anyway, the thing with IKEA is it's a furniture store mainly where like you build everything. So imagine the IPDE process, using it or not using it. Using it would be like getting the bed home and you lay it out on the ground and like you whip out the directions and the directions tell you step by step what to do, right? Take this piece, use this screw, do this first, tighten this second, right? Makes the process easy. You follow. But if you're not using the IPDE, that is like throwing all those pieces of that bunk bed you're supposed to build onto the ground, not having any directions, and you trying to figure it out by yourself. Now, what do you think is the more efficient way to do it? Follow directions step by step with guidance, or figure it out yourself? Now, if you're a man like me, you're going to say figure it out yourself. But also, if you're a man like me who's gotten in trouble many times with his wife for trying to figure it out myself and making things worse and then needing to go back and buy another one, you've learned that the directions are the right thing to do. Yeah. Should have back tested that. So does that make sense? On why we don't need to get confused by both, because we should only be focused on one. It's hard. It's not easy. It's hard because, like, again, when you're in the learning phase, you're learning all this stuff. You're like, oh, divergence, I know that. Doesn't that mean bearish, right? So you're seeing all these different things. So it is difficult. But once you get to a point where you've kind of decided, right now you're in the learning phase. You're just taking in information from everywhere. So you're seeing everything, you don't really know how to use it yet, but you're like, oh, I see that, that means this, right? And so it's easy to get confused. Once you get to the point where you've locked in on a strategy and you kind of know you've created a process and you know your process, it does make things a lot easier because now you know what to ignore and what not to ignore. You know what's relevant and what's not relevant. So it is fair to feel that way if you are in the learning phase, because it's just you're a kid in the candy shop. And it's just terminology floating everywhere. But it does get easier. So anyway, high and tight flag. Beautiful idea for a bullish breakout here, right? As always, there's 3 ways to enter a flag. And I see one more question about divergence. I'll get back to it in a little bit. But there's 3 ways to enter a flag or any breakout pattern. There's the before, the during, and after. You can look at this on any time frame, right? The before, right, is anticipating the breakout of the flag. So you see how our flag keeps hitting these bottoms here? Right? Bottom, bottom, bottom. If you're anticipating a bullish breakout, wait for the flag to come to another bottom at this point. Obviously, wait for your reason for entry. And then involve yourself in the breakout prior to it happening. So imagine this as being like, hey, not that you would want to be in a volcano, but imagine this was like you were in a protective bubble inside a volcano. Imagine like you're anticipating that this volcano is going to erupt. And for some reason you decided to go down into, this is not my best analogy. Some reason you decided to go down into the volcano in a protective bubble because you want to be in the volcano before it erupts. Yeah. That is this. So before is going to be 1. That would be entering kind of at the lows here. You have no sign that this is actually going to break out. You are anticipating. This is your most aggressive way. You are anticipating by the facts that you have gathered that this is more likely to break out. You also have a really good risk reward because guess what? If you get involved down here, right? Where do you know you're wrong? Right? Our stop loss needs to be at a location where we know we're wrong, but also we have enough breathing room. Where do you know you're wrong at? Who can answer this? A lava cake. Oh. Sorry. Channeled my inner Homer Simpson. I just had a friend of mine who just lost 29 pounds and is down to 7% body fat. Now I'm motivated. And I'm watching. He did a nice little interview. He's like, what is one of the things you did? He said, I stopped snacking. I'm like, damn it. That's the one thing I want to do. Shoot. All right, where stop goes? Where do we know we're wrong at, guys? By the rules of the flag pattern. What shouldn't happen? The lows, right? We shouldn't go below the lows, right? Now, we don't want to put our stop loss a pip below the low. That's silly new trader stuff. You silly new traders, right? But we want to be below the lows. So we can position ourselves with a move like this. And again, not that you would shoot here, but our bigger prediction is 186. I'm not even going to zoom out that far. It's up there. Obviously, we would look for intermediate positions to take profits off. But yeah, you can see you can get the best bang for your buck. So that is going to be the before. The during would be during the breakout. So waiting for price to break out, right, of the high resistance zone. That confirms, that the breakout is happening. So if you're a breakout trader, wait for that breakout and get involved on the way up. So instead of being in your lava-proof bubble at the bottom of a volcano, a chocolate lava volcano, right, waiting for it to erupt, this is you standing at the top of the volcano, and as soon as the lava shoots up, you're shot up with it. We're just gonna butcher this analogy. We're gonna go with it, guys. So that would be the during. The after is waiting for confirmation of the breakout, right? Because you can get caught in all types of false breakouts here as well. That's the risk of it. If the move goes straight up, you're up with it. But if it's a false move, you're in trouble, right? So the after would be waiting for the confirmation of the breakout, and then either like a confirmation would be a higher high, higher close, either getting involved right after that, so at least you have confirmation that it did break and close above, or waiting for the breakout and waiting for the retest, and then looking to get involved after that. So those are 3 ways that you can enjoy a breakout. I think I shot this into our pro trade log already, did I? Yeah, high and tight flag, yeah. Now let's go back to Devin's question here. Hope you enjoyed the vid. Like if you did, leave any comments or questions below or any ideas for future topics as well. And tomorrow, I hope by saying this makes me do it, I've got another video episode of the Trading Coach podcast for you. So yeah, if I don't put it out, then I'm a liar. See ya!